Right now, shares of PMGC Holdings Inc., trading on the Nasdaq under the ticker ELAB, are at 5.45 per share. That is a modest move up for the day, higher by about 0.55% on very thin volume. But that 5.45 price point is the entire story. Anyone looking at this stock is immediately confronted with the tension between that price and the 52-week high, which sits at a staggering 216.09. That is not a typo. This is a stock that has shed more than 97% of its value from its peak. The immediate expectation is that this is a dead company, a zombie stock simply waiting for the lights to be turned off, a cautionary tale of a bubble that is comprehensively burst. That is the narrative. But the reality of what is happening under the surface with ELAB is so much more complex and frankly so much more aggressive than just a simple story of failure. The reality is that this stock is currently one of the most intense battlegrounds on the entire market. It is not just a failed company. It is a company with a 63% short interest, a days-to-cover ratio of over 12, and an astronomical short borrow fee rate that has recently been clocked in over 690%. This is not a stock quietly fading away. It is a nanocap company at the center of an extraordinarily expensive and high-risk war between bulls who believe in a total reinvention and bears who are paying a fortune for their bet on its demise. To understand how we got here, you have to understand what PMGC Holdings or ELAB used to be. The expectation many investors had was built on its former identity as Elevai Labs. This was a biopharmaceutical and skincare company, a story stock focused on physician-dispensed formulations, and more recently, a pipeline product called EL22, which was aimed at the massive obesity market. Like many small-cap biotechs, it was a high-risk, high-reward bet, but that bet failed. The company found itself in dire straits, receiving deficiency notices from Nasdaq for failing to maintain the 1.00 minimum bid price and failing to meet stockholders' equity requirements. This is the classic death spiral for a small public company. To save its listing, the company was forced to execute a 1-for-7 reverse stock split back in March of 2025. This move artificially boosted the share price back into compliance, but did nothing to fix the underlying business. And it explains the bizarre 216 high and adjusted price that reflects a pre-split valuation that has long since evaporated. Investors who helped through that period saw their share count decimated, and the value continued to plummet. This is the history that shorts are betting against. They see a failed biotech, a reverse split, and a delisting threat as a clear-cut case for a zero. But here is the reality check that forces a complete reevaluation of the entire thesis. PMGC Holdings is not a biotech company anymore. The narrative that many shorts and disillusioned investors are trading on is obsolete. In the last few months, the company has executed a complete and total pivot in its business model. This is no longer a story about skincare or obesity drugs. The company has terminated its old direction and announced a new strategy to become a holding company for acquiring high-growth CNC precision manufacturing businesses that serve the aerospace, defense, and industrial markets. This is not just a plan, it is happening. The company has already completed the acquisition of AGA Precision Systems, a CNC machining operation. Just days ago, at the end of October, that new subsidiary, AGA, completed its acquisition of another target, Indarg Engineering, expanding its footprint. And perhaps most critically, the company just announced that AGA Precision has completed its ITAR, or International Traffic in Arms Regulations, registration. This is a crucial step, as it makes the company compliant and eligible to pursue high-value manufacturing contracts with Tier 1 defense contractors and aerospace original machinery equipment manufacturers. The company has also reported a sales backlog of over $711,000 and is bidding on over $700,000 more in quotes. For a company with a market capitalization of just $4 million, this is not insignificant. This pivot is the crux of the entire battle. The market is now split between two completely different stories. The short sellers, who have amassed a position equivalent to 63% of the entire public float, are betting that this is just lipstick on a pig. Their thesis is that a failed biotech cannot suddenly become a successful defense manufacturer, that this is a desperate roll-up strategy doomed to fail, and that the company will burn through its remaining cash long before these new acquisitions can generate meaningful, sustainable profit. And they're looking at the horrifyingly bad historical financials of Elevai Labs and betting that the new PMGC is no different. And to be fair, the risk is enormous. This is a nanocap stock with a total market value of roughly $4 million. That is smaller than the valuation of a single luxury home in the city where it's headquartered. It has virtually zero institutional ownership, only about 2.2%, and no analyst coverage whatsoever. There are no professionals validating this story. It is a high-wire act with no safety net. But here is the reality check that forces a complete reevaluation of the entire thesis. The cost to maintain that 63% short position has become excruciating.
The borrow fee rate, the interest rate short sellers must pay to borrow the shares they need to sell short, has been reported by data providers like Fintel to be over 690%. That is not a 6.9% fee. It is 690%. This means that for every $10,000 in a short position, a seller is paying nearly $7,000 in interest per year, or almost $19 per day, just for the privilege of holding that bet. This is not a sustainable cost. It implies an incredible scarcity of shares available to borrow. In fact, recent data has shown the number of available shares to borrow frequently dropping to zero. This is a direct consequence of the stock's tiny float, which is estimated to be only around 628,000 shares. When you have a short position of over 420,000 shares, as was recently reported, and a total float of only 628,000, you have a major problem. The days-to-cover ratio of over 12 means that based on average volume, it would take shorts more than 2 full trading weeks to buy back all their shares to close their positions. They can't get out quickly, and it's costing them a fortune to stay in. What's your take on that 694% borrow rate? Is this a smart bet against the company or a sign of desperation from shorts trapped in a bad position? This is where actionable analysis for investors becomes critical. This is not an investment, it is a speculation on a highly volatile special situation. Investors interested in this name must know how to track this data. You can find short interest data on Nasdaq's official site, though it is reported with a lag twice a month. For real-time borrow fee rates and short share availability, services like Fintel or Ortex are what traders watch. A rising borrow fee and zero shares available are signals of maximum pressure. Another critical data set to monitor is the fails to deliver, or FTD data, which is published by the SEC. Looking at eLab's FTD data from late summer, there was a massive spike where hundreds of thousands of shares failed to be delivered on a single day. While FTDs can happen for clerical reasons, persistent and large FTDs can sometimes suggest that shares are not being located, a hallmark of extreme market stress and a potential signal that retail investors often watch for. The recent volatility, with the stock screaming from 5 up to over 16 and back down again in October, shows how explosive this setup is. The slightest bit of positive news, like the ITAR registration or another small acquisition, can trigger a panic among shorts, forcing them to buy back shares at any price. This is the short squeeze scenario that many retail investors are betting on. The path forward for PMGC Holdings is a binary one. The future outlook depends entirely on which narrative wins and which side blinks first. In the first scenario, the short seller thesis proves correct. The new manufacturing roll-up strategy is too little, too late, the 7-Eleven backlog is a drop in the bucket, the acquisitions burn cash, and the company's new revenues are not enough to offset its operating costs. The 690% borrow fee eventually drops as more shares become available, or as longs give up, and the stock slowly bleeds back down towards delisting and eventual bankruptcy. The 63% short position closes out with massive profits. In the second scenario, the bull case, the reality of the pivot wins. The company continues to execute. It leverages its new ITAR registration to land a small but significant defense contract. It announces another acquisition. The revenue numbers, while small, show sequential growth. With a float of only 628,000 shares, it doesn't take much buying pressure to move the needle. The shorts, who are paying hundreds of % in interest, face a margin call cascade. The 12.5 days to cover becomes a trap, and a short squeeze initiates, forcing a buyback that sends the stock flying irrespective of its fundamental value. Comment below if you are holding eLab shares and what you believe the new manufacturing business is actually worth. This is what makes the current 545 price so fascinating. It's a moment of perfect equilibrium before one of these two outcomes takes hold. The expectation is that you are looking at the corpse of Elevai Labs, a failed biotech. The reality is that you are looking at the birth of PMGC Holdings, a nano-cap defense manufacturing holding company that is simultaneously the target of one of the most concentrated and expensive short attacks in the entire market. The story here is not about the past. It is about whether this company can build a new future faster than short sellers can force its demise.